Well, look, we're trading at 15 times 2019 at this point, so it's kind of hard to be bearish with the 10-year sticking around 3%. There are obviously margin compression issues afoot. The issue of inflation, which could be exacerbated by tariffs, and also the bleeding in to a reduction in pre-tax margins of the corporate tax cuts. Some of that's going to go to consumers. So those are pressures on the margin side. But look, we've had over 20% earnings growth 2 quarters in a row. Let's just make up a scenario that PE multiples stay flat for next year and we get 8 or 10% earnings growth. Well, there you go. 8 or 10% price return, a couple percent of dividend yield. It's just hard to get really bearish with these valuations. Hard to get bearish,
but there are these big headline issues where people are going to be watching very closely what Powell has to say today, where they have concerns about what happens at the G20. What do you want to hear from Powell today? What would be the most important thing?
Well, you know what I think would be a nifty answer here is the one that Mnuchin's been floating. It's been sort of in the news a little bit. Maybe a couple fewer hikes, but a faster wind down of the balance sheet. You know, imagine 2 hikes instead of 4, but the balance sheet winds down a little bit more quickly.
I mean, it has the same impact of drying up liquidity, but maybe less of an impact on Main Street that way.
Well, I would put it this way. It would quicken the normalization of the yield curve and reduce the odds of a flattening so that cash alternatives don't get sort of crowded out by Fed funds, but the long end starts to drift up to that 4 handle. And
it wouldn't impact things like auto loans or home mortgages or things along those lines?
Some are fixed, some are floating, but it would just be a step closer to normalization without, say, a full 4 rate hike cycle. That could be a little bit too much on the short end.
Yeah, that's interesting. That's actually something that we've heard from Kevin Warsh for a while about. JJ, what do you want to hear from Powell today? I know you're focused on the G20.
Yeah, I think any clarity around, you know, if you think about, we have the Fed minutes coming out. The Fed minutes didn't take into account what's happened in crude oil being the greatest contributor, or energy, I should say, being the greatest contributor to inflation. Where does he stand on inflation? Because we're not seeing any inflationary pressures whatsoever, and I think that's the biggest thing that's changed over the last month. We know we saw a little bit of wage growth. You know, we'll get a report in about a week here on employment again, but I think what's going on in energy, has that changed his outlook at all?
Although I would still argue it's the conversation about normalized rates that's the issue. What is normalized? Because you don't need to see inflation if you just want to get back to a normalized level.
But it could also be, oil could also be indicating something about just how strong the economy is.
It could be. So, but you know, the numbers are still really strong. As much as everyone says he shouldn't do things, housing has weakened, obviously. But you know, if you think about their mandate, it's employment and inflation. They're not really supposed to care about the stock market, and employment's going well, but inflation, there doesn't seem to be a whole lot of pressure there at the moment. So again, how is he sort of rectifying those two? Yes, I think we need to talk about normalization, but the normalization and the environment we have now or the environment we see perhaps happening in a year.
Simeon, I know that you are looking at 15 times earnings and thinking that that's cheap. If something happened at the G20 this weekend, something that was bad, something that indicated that China and the United States is not going to get any closer and that these tariffs are going to roll in, they're going to raise to 25% in January, and they're going to go to all $500+ billion worth of goods between the two countries. Would that change your mind about 15 times earnings looking cheap?
Not in a huge way. You know, of course, there would be a sell-off on the news, but I think that we're priced in for a little bit of margin compression. You know, the bigger tail risk is, of course, we are seeing heightened geopolitical tensions all over the place, and any kind of military thing, that's going to cause a flight to quality, and that's probably about the only scenario where you would actually see the long end of the curve really, really come down. But to bet on that is kind of expensive insurance.
Okay, let me throw one more of this worries that are out there your way. The idea that things are slowing down in the economy around the globe and that eventually that is going to wash up on our shores. And despite the good news we've seen here from the economic perspective, that's not something we can withstand, that will eventually drag us down. That goes back to this idea of oil being an indicator of what's really happening out there. If the economy weakens, and you have all these other issues, does that change your mind?
So I'd flip it on its head because I think the U.S. expansion is ahead of the rest of the world. If you look at the sell-off in the last 2 months, actually emerging market equities outperformed the S&P even in an environment where oil was dropping precipitously. So, for emerging market stocks to hold up when commodity prices are falling and there's a sell-off in the U.S., I think there's at least as much of an opportunity for growth to pick up. I mean, we're only trading at 10 times PE in emerging markets.
Well, that goes back to a call we heard from Morgan Stanley earlier this week, where they were downgrading their U.S. Stock outlook, but upgrading.
There have been a few voices now starting to become more bullish on emerging markets. I think you can wait a couple quarters on that, but I do think it's certainly a distinct possibility.
JJ, what do you tell people if...
Well, I was just going to follow up on that. I think the one tough part for many of the audience watching your show, a lot of retail investors, is when they hear emerging markets, they're really not sure how to evaluate them or what to do with that. And I think sometimes that becomes a little bit difficult. So if they are going to go into there, they probably want to do so maybe through an ETF or something larger, because people have a tough time assessing companies they theoretically understand that are in the U.S. So when they go to emerging markets, that is, I hear people say that a lot, and there's nothing wrong with it, but I would caution people watching the show, do you really understand the political environment in those countries, and do you really understand the risks there? Because I think that's how sometimes people get in trouble really quickly, is they go into these without necessarily understanding what goes along with that.
It's not just that. You also have to have a view on the dollar if you're going to be investing in overseas markets, because if the dollar continues to strengthen, are your gains overseas not going to translate back into quite as much?
Yeah, absolutely. So as I said, there's a lot there, and again, I don't want to belittle the recommendation. I tend to agree with you that they overall, they are much cheaper on a PE basis than you have in the U.S., but too often I see people kind of run into that fire, if you will, without understanding at all what they're running into and what countries.
All right, very short term, we had a good day on Monday that people were looking askance at the entire time, like, oh, this is not good, that it's rebounding, this is just going to sell off. It held up 350. Yesterday, we looked like we were down 130 or so pre-market, ended up 108. Is this, at best, I guess most people would say this is a bear market or a rally and a correction. And we have turned. We're now half empty on viewing this market. But those are two pretty good sessions, and today we're indicated up another 100. Have we reached some type of intermediate-term bottom based on the VIX or based on other indicators?
What I would say is you've reached a point where people want to take off risk as much as they can heading into.
So they're going to sell into this.
Well, I think actually a lot of firms may have been short over, sold into that rally, et cetera. And so a lot of the bigger firms, in my opinion, are just flattening up some of their things. And also, I think, one of the things you've seen recently is, has this gotten overdone with technology? And it's kind of funny to me. Yeah, a little bit, I think it has. But that being said, Joe, the FANG stocks still haven't performed overall. Netflix was the only one that actually performed yesterday, so I'm really interested to see what. I think Apple is the one with its suppliers that people are still the most nervous about heading into the weekend.
We're right around a flat line for the year on a lot of the averages. We're going to end up with a 5 or 10% gain, or are we going to be down for the year?
I think they'll go for a 10% gain.
You think that'll end up by the end of December?
No, I think that's a really high. That only happens on the 5% you talked about earlier. If things are great, I think it's probably 5%
so you
or
think
less.
We're in do you think that, or you think we've done enough
look,
work?
we had a pretty good first holiday weekend, so the retail numbers are strong, the consumer's strong. I think you could have a little rally into the end of the year. I'm not sure I'm on board with the technology side. We're still at 3 times the price to book of growth over value. That was only eclipsed in the tech bubble.
The only thing I would say is if we have any kind of settlement at all, I think people are going to come for those stocks in terms of
174 on Apple. I don't know. Apple's related to China, but could be just as important if that makes a stand.
Psychologically, I think it is.
It is, probably.